Well, good morning, Tony Virtue speaking, and welcome to our newsletter. As you can see, safely back from Gallipoli, and my great thanks to those of you who organised that. It was just a magnificent time for all Australians. Last week, obviously dominated by our budget. I think it's fair to say it was better received than the previous one. We do have full details on the website, but the salient points from a financial planning point of view. No changes to superannuation. We were a bit worried, but no, we came across okay. Tightening of the asset test. For those of you who are getting senior cards, that will be grandfathered. So in other words, even though you may not qualify now for a part pension, you will still get your seniors card. For the many of you in small business like ourselves, $20,000 immediate asset write-off. That'll be good. It'll be stimulatory for the economy. And we have 3 million small businesses in Australia, so that should be 3 million happy people, I'd say. So that's probably a good news story that will probably stimulate the local economy as we go along. Market's sort of stuck in this 5,600, 5,950 mark at the moment. Very much a war of attrition with companies primarily getting these income streams back to shareholders. Dividend yield sitting around the 5s at the moment. The numbers from the banks weren't terrific last week, as you could see. Very much a very, very flat earnings, so the market did not like that. That said, the actual dividends paid out were the same as before, so providing the dividends hold up, I'm not overly concerned, and I probably see that as some buying opportunities. I mentioned in my notes there has been a repricing of bonds. People are expecting more money for their investments, which is not unreasonable. Off a very, very low base, so you can see that longer term bond yields are going up a little bit. That, I think, is a healthy thing, to be frank. Property prices, again, still pretty strong in Sydney. RBA dropped rates again to 2%. I really hope that is as low as they go. I think you reach a point where interest rates become inelastic in their demand. If you can't borrow money at 5%, you won't borrow money at 4.5 or 4, and we get to a stage where it just creates a property bubble. Obviously that's a Sydney-based situation. If you're in Tasmania today, if you're in North Queensland, it would be a different story. But hopefully that's as low as we go. And there is quite a big spread now between the rent you're getting from properties or the dividends you're getting from shares and its equivalent in cash. So again, forcing people up the risk curve, which I think has limitations there. Getting towards year end now, so if you do get the chance to top up your super, it's a good thing to do. It will give you a lot more choices in retirement. If we can get to critical masses where you can generate really good income streams without chewing up the capital, it will give you an enormous step up in life, and hopefully we're living longer and living healthier. So we are seeing a real trend that way to taking, if I can say, the gains from property, the gains from shares over the years, take some of that off the table, put it into income streams for superannuation, draw that down to live off in retirement, and travel the world if you're able to, and enjoy life there. Alright, well that's enough for today. We have a function down at Hugo's next week. I look forward to seeing as many of you as possible there. So I'll see you next time. Take care, bye bye.